Understanding closing entries, a simple guide for English learners. Hello, and welcome to our English language learning series. Today, we're going to explore a very interesting topic in the world of accounting: closing entries. If you're curious about how businesses wrap up their financial records at the end of an accounting period, you're in the right place. Closing entries are journal entries made at the end of an accounting period to transfer the balances in temporary accounts to permanent accounts. This process helps in preparing the accounts for the next period. Temporary accounts include revenues, expenses, and dividends, and they need to be cleared to zero at the end of the accounting period. This is done so that they can start fresh in the new accounting period. The main purpose of closing entries is to bring the temporary account balances to zero and transfer their balances to permanent accounts, like the retained earnings account. This is important because it helps in measuring the income and expenses accurately for each period. It ensures that the financial statements of the business accurately reflect the income generated and expenses incurred during that specific period. Making closing entries involves a few steps. 1. Close revenue accounts. Transfer all revenue account balances to the income summary account. 2. Close expense accounts. Transfer all expense account balances to the income summary account. 3. Close the income summary account. Transfer the balance of the income summary account to the retained earnings account. This shows the net profit or loss. 4. Close dividends or drawings accounts. Transfer the balance of any dividends or drawings accounts to the retained earnings account. Let's look at a simple example. Imagine a business has a revenue of $10,000 and expenses of $6,000 for the accounting period. The closing entries would be: 1. Debit revenue account for $10,000 and credit income summary account for $10,000. 2. Debit income summary account for $6,000 and credit expense accounts for $6,000. 3. Debit income summary account for $4,000, net profit, and credit retained earnings account for $4,000. 4. If there are any dividends, debit retained earnings and credit dividends. Closing entries are a crucial part of the accounting process, ensuring that financial statements are accurate and ready for the next period. We hope this video has helped clarify what closing entries are and why they are important. Keep learning and exploring, and we'll see you in our next video.